The updated SREP methodology for 2024 introduces improvements to the assessment of internal governance and risk management frameworks, as well as to the assessment of risk to capital. These updates are intended to strengthen the financial resilience and stability of supervised entities and to ensure a more precise alignment with supervisory expectations. The recently published SREP methodology introduces improvements in the assessment of several key elements. The internal governance and risk management framework emphasizes the importance of robust governance structures, including both effective management bodies and a well-established risk culture, rather than specific controls for capital, liquidity, and funding risks. These specific risk controls are expected to be consistent with the institutional's overall governance and risk management framework and vice versa. On the other hand, the risk to capital assessment covers 4 types of risk, each with its own methodological approach. A more in-depth review of the impact of ESG factors on credit risk is introduced, increasing the weight of these elements in the assessment. The market risk approach and the framework for interest rate and credit spread risk in the banking book have also been updated with more detailed methodologies to capture vulnerabilities arising from changes in interest rates and in the perception of credit spreads. Finally, the methods for assessing operational and ICT risk have been refined, with greater emphasis on dependencies on third parties and the resilience of information technology to prevent system failures. Supervisors assess how banks manage these risks and the elements that could adversely affect their capital or liquidity, both now and in the future. This process determines an organization's capital and liquidity needs and the adequacy of its internal arrangements and risk controls. This technical note summarizes the ECB's updated documentation on the SREP methodology, focusing on the improvements and updates included for this year.